Okay, so thank you guys for being here today. I'm with Kyle Ridenour, and we are going to be talking about how you can tap into your home's equity and leverage your home's equity for different things that you may want to do with your house, or if you think you want to move, or different things. He's going to be talking about that. Kyle and I met each other. I work in a neighborhood a lot that he lives in, and so we've connected that way and kind of have done some community events together. So we're excited to have him on today, and he's going to be sharing his screen with us. I'll kind of jump in and ask some questions. If you guys have questions that you want to put in the comments, you're welcome to do that as well. But I'll let Kyle take it away from here and kind of tell us about himself and then kind of jump into the topic for today.
Yeah, thanks, Jenica. It's always nice to be here with you and join you on this Facebook live stream as we wanted to talk about this topic that's really popular, the home equity loans, especially when it gives you the possibility of unlocking your equity and borrowing your equity without having to refinance your first mortgage, because we know we're still in a high interest rate environment, which we have been for the last 3+ years now. And even though there's talks of rate cuts on the horizon, I'll explain how that doesn't always correlate to lower mortgage rates. Now, in the long term, it will, but in right now, in the immediate time frame, home equity loans can still be a really good, viable option for quite a few years ahead. So, with that being said, I'll start out by giving a little context, a little background knowledge on the Fed rate cuts, like I mentioned. And what this does is just allow you to understand that when we hear Fed rate cuts on the news, or that there's possibly tomorrow they're expecting a quarter percent cut, that it doesn't always again correlate to lower mortgage rates. And the reason is because the Federal Reserve's federal funds rate is for short-term borrowing. Okay, so that means borrowing between banks, smaller things like credit cards, personal loans, or even home equity adjustable rate mortgages as well, or second loans like we'll be talking about. They do, they're more correlated to these Fed rate cuts, but the conventional 30-year Fannie Mae, Freddie Mac mortgages are not going to be directly affected by the rate cuts. Because mortgage rates are tied to long-term bond yields, especially the 10-year treasury rates. And the lenders price mortgages based on longer term risk, like over a 10-year horizon. So for that reason, when we hear the Fed rate cuts, quarter percent, the Fed funds rate is going to be down to maybe 3.5 to 3.75. That doesn't tie directly to mortgage rates. Now they do move, they correlate in, like I said, the long term. But there's things that can change. For example, if inflation remains high, the geopolitical risks, the tariffs, all these things that happen in our world can affect the mortgage rates to increase or decrease without the Fed's doing anything to the Fed funds rate. So just keep that in mind. In short or summary, the Fed rate is short-term bank lending, mortgage rates, 30-year conventional rates are long-term bond market. And they're independently. So although we do anticipate this rate cut tomorrow, the mortgage bonds have already factored in that, and so 30-year mortgages have already priced that in. As we've seen the last 6 months, mortgage rates have dropped a good amount in anticipation of each Fed rate cut. So I just wanted to give you a little bit of understanding there. Any questions before we move on, just on the basics of the rates and how they work, Jenica?
I think that's good to explain to, yeah, our clients and followers just how that works because we often do get asked, oh, we hear they're cutting rates, does
Yeah.
that mean interest rates are going down? And sometimes we've even seen they've done a rate cut and then they've trickled up a bit. So,
That's the
yeah.
ironic thing about it is we hear on the news they just want to blast, the Fed's cutting rates, and without any context to it, you're right. They reach out to us lenders and say, "Well, what's the rate today?" And you go, "Well, it's higher than it was yesterday or the day before." Well, they just cut the rates, and you have to explain this to them that it is because they're two different things. But
Yes.
overall, if you track it like year by year, if the Feds drop their rates, then the mortgage rates will typically follow suit. Mhm.
Okay, perfect. Yeah, I
Yeah.
think that's good. We can move on.
Okay, good. All right, so we'll start out here with just a couple quick slides on the home equity loans. And like I mentioned, we're still in a high, interest rate environment today. Even though rates have come down from the highs of 8% or the 7%, even at 6%, it's a higher rate than what most homeowners obtained in prior to 2022, I would say, when the rates started to creep up. So if homeowners have a 3% fixed rate, 30-year mortgage, it's really hard to refinance and pull cash out at a 6%. So instead, you'll be able to access your home's equity to unlock the equity by keeping your first mortgage in place. So you still have that low first mortgage payment. And then you can borrow a second mortgage, these home equity loans. And there's three different options that we can consider. Right now, a HELOC is very common. Many banks and credit unions offer this and lending institutions. It's referred to as a home equity line of credit. We'll get into the next slide, what differentiates this from the second one, a HE loan. That's more of just a home equity loan. And then the third option, we call it Home Safe Second. It's referred to as a reverse mortgage. That's a second mortgage. So again, it doesn't affect your first mortgage payment, but it does allow you to tap into your equity with ease. And so that's another option for homeowners over the age of 55. So we'll go ahead and move on to the next slide. And what this breaks down are the three different options. The home equity line of credit is secured against the home. The interest rate is adjustable and will go up and down. And usually the term is about a 20 to 30-year term for these mortgages or second mortgages. Um, and they do have a draw period. So within the first 10 years, if we refer to that as the draw period, that's when you can pull money from this home equity line of credit. Um, if you think of using the equity in your home, um, you might qualify for a $200,000 line of credit. Might be something you want to have available in case you need to do work to the home or you want to use it for future expenses. So you can set this line of credit up and borrow from it as you need it. And you only pay interest only on the funds you've used, which is a nice feature. It does give you probably the most flexibility out of all three of these options. And you can pay back more than the interest only in the first 10 years, but that's the minimum that has to be paid back. So when we think about how can we borrow our equity in a reasonable manner for the next 10 years, have a pretty minimal payment, and we can always refinance these loans later on down the road if our 30-year conventional mortgage rates drop into the fours or fives, and you decide, well, now I'm going to combine my first and second because it makes more sense. So they're pretty straightforward. If you have a home that's worth 500,000, you can typically borrow 90% of your home's value when you add in the first mortgage as well. So a lot of homeowners have built up a lot of equity in this last 5 to 10 years. So this is a very popular option, and the line of credit can be used again for really whatever you need it, and that's the best part about it. So any questions on that one so far, Jenica?
I was going to ask, so when the interest rate, I know it's adjustable, so does it goes up and down like based on the draw period, or how would you know, like what would be the typical rate on a HELOC right now?
Yeah, so that's
Or,
a
you
good
know, it depends on
question.
credit and
Right
stuff.
now, most HELOCs are tied to prime rate, which is about 7%. Um, and if the Fed does cut their Fed funds rate, we can assume that the prime rate will also drop typically by a 1/4%. So on these home equity loans, like I said, they're a little different than a 30-year conventional mortgage. They can see that benefit from the Fed rate drop. So right now we're seeing rates at about 7 to maybe 7.25 on most HELOCs that we're offering.
Okay.
And that goes
Perfect.
up or down because again, we're gonna hope that the interest rates continue to come down. So that rate in the next year could be in the sixes or in the fives before you know it. But if you have this mortgage open for 30 years, um, the rates can go up too when rates go up, and you'll just pay interest only for the first 10 years. And then after the draw period, they will take your full balance and amortize that over the next 20 years, and you'll pay principal and interest. So the benefit is in the short term, the first 10-year draw period, you can keep your payments down really low and interest only. After the 10-year draw period, then your payment would go up. So that's something to factor in too, is if you can't refinance by year 10, you'd have to be able to anticipate, okay, I can pay my, if I borrow just like a $50,000 line of credit, you might have a payment of just a few $100s in the first 10 years. But outside of that, when you get to year 11, then you'd be paying maybe closer to 1,000 or $1,200 to pay back the principal and interest. So you just have to keep that in mind that that's the way it's structured.
Yeah, yeah. Well, and then the HELOC too can be good. I mean, I know the market's shifted some, right? Where some areas prices have softened and things, but we
Hmm.
still have some properties where there's multiple offers and, being contingent is a challenge for some sellers to get over if they're getting a lot of activity on their property. So this could be something where people say, what are my options
Hmm.
to try to buy without selling? Tapping into your home equity is one option to get that money, use it for the next house. And then when you sell your current house, you can obviously um,
Yeah.
pay that lock off. But so that's just an idea to use it in that way too.
And a lot of people will take the home equity line of credit to fix up their home because they know that
Yes.
in this market, the nicer your home is, it'll sell a lot quicker. So they
Yes.
might set up the line of credit, do work on the home, and then like you said, if they still have some funds to tap into, maybe they can apply that as a down payment on the home they want to buy. So the flexibility is the key on most of these equity loans. You can use them for a lot of different things.
Perfect.
Okay, good. So we'll go to option two. This one is we call it the HE loan, and it's a second mortgage. The main difference is this is a loan that's a fixed interest rate, and it will be spread out the payments over 30 years typically. Um, with all mortgages, a lot of these second mortgages or equity loans, they can also be shortened on their terms to let's say 20 years. But let's just use an example that you take $100,000 to maybe put a new pool in and fix up your backyard. And you just wanted to say, I want to have a payment that's stable, that's consistent, that I know what I'm going to pay every month for the next 30 years if I keep this HE loan in place. So that's the advantage of this. If you, in that example, at the rates, like I said, 7% to 7.25, you'd probably have about a $700 a month payment over the next 30 years. But with no prepayment penalties, you can always pay above the 700 every month to pay it down quicker than the 30 years. So I'd say that loan is popular right now too because um, it depends on how much you want to borrow, but these main options that are equity loans, the closing costs are going to be a lot lower than a conventional 30-year rate. Most of these, if you're taking a mortgage or a loan amount of less than 250,000, you wouldn't be required to pay for an appraisal or have an appraisal. We would use an AVM, an automated valuation model, which is more of an electronic estimate of your home. Um, so that's another added plus I would say is Usually $500 to $1,000 or less is what your total cost would be to take one of these second mortgages out. And like it says there, it can be a standalone second. So even if you don't have a first mortgage, maybe your home's free and clear. Like I said, with the lower closing costs, you might decide, oh, I just want to take 50,000 or 100,000 and just do it at a 7% rate for now, without having to, add in more closing costs of a conventional loan and an appraisal. So it's all three of these come down to what's the suitability and what's the best needs for the homeowner. And as Jenica knows, being in this business, real estate's the same. You find out what your clients' needs are, and you cater to those and make sure we put them, match them up with the best products or best, in Jenica's situation, best home available for them. Okay, so that one, fixed rate, again, the rate's about the same, 7 to 7.25, but they should be coming down as well. So I would anticipate these HE loans are still going to remain, very popular here in the next few years. Um, The Home Safe Second, what that is it's a fixed rate reverse mortgage second. So it mirrors the HE loan, the option we just talked about. But what it is for homeowners over the age of 55, can tap into their equity this way. And it's a little bit more convenient and even more flexible than the other two options because you're not going to have a required monthly payment. You're not going to have an interest only payment. All you're going to have is to continue to pay on your first mortgage, which you would have on all three of these options. If you had a first mortgage in place, that would stay the same. So that's the true benefit of these options is that you keep your current first mortgage in place, low interest rate, payment that you've been paying for a while, but then these give you, another option on how to tap into the equity, in the most feasible way for the homeowner. So with this loan, there's no term. What that means is that as long as the homeowner is still living in the property and paying their taxes and insurance, and it's their primary residence, the loan will go on indefinitely until they move from the property or pass away. It is available in California, Nevada, Arizona, and Oregon, which I'm licensed in. If you need any mortgage, assistance, I can help in all those states. And so we do offer this reverse mortgage second, as well in those states.
Yeah, that's a great option. So
Mhm.
then for somebody who is looking to move from their property, is that also that home safe second, they could use that for the down payment on the next property, or is there a certain amount of time that they have to hold the loan? Like let's say they want to use the equity to
Mhm.
get into the next property and then
Well, I mean,
ah,
yeah, you could do that hypothetically, but this home safe second is predicated on it being your primary residence. So,
okay.
usually you'd have to still stay in the home for 12 months, I would say, um,
Mm,
and plan on selling the home pretty immediately after you've purchased your new primary residence. So
mhm.
if that's your plan, you could still, I could still you see, still using that to bridge the gap there.
Okay. Okay, perfect. Yeah, those are all good things to consider.
Hmm. Um, so the next slide I'll bring us to is just going to be, one of our marketing pieces. So we will again touch on our HELOAN option here at Guild. And, the nice thing about this is that the qualifying your credit scores don't have to be 750 or 800. We go down to 660 on the credit scores. You can borrow loan amounts up to 500,000. So if you have a really, high home value or a lot of equity in your home, we can lend up to 90% loan to value. So that's, a great opportunity for homeowners. These options too, they can be done on second, um, second homes or investment properties. So a lot of homeowners who have rentals, they also have a lot of equity built in those properties. Those might be the homes they want to pull money from instead of their primary residence. So this really gives you a lot of options, whichever way you want to go, whichever property you want to borrow it on, whether it's your primary residence or a vacation home or investment property. And again, the credit scores are really reasonable. So, um, the key here is we want everybody to be able to keep their low first mortgage rates because those 4% rates might not come back, again. So if you can hold on to those and borrow your equity with these alternative options, it's a really good idea for most homeowners. And then in the future, most would refinance eventually. But let's say this will be a nice game plan for many for the next 1, 2, 3, 4 year, 5 years maybe. Then if rates settle down, closer to the 5% range, then more people would look at doing a traditional cash out refinance. But um, right now, in a similar situation, if you wanted to just take 50,000 or 100,000 and you lumped it together with your existing mortgage, even if it was around 200,000, your payment would go up over $1,000 a month. So borrowing through the HELOC or the HE loan can keep your payments much lower. And I think right now is a great opportunity for that.
Can we real fast while you're talking about that? So
Mhm.
like the HELOC, the HE loan, I know, which is just like a second mortgage. So the cash out refinance is different from both of those,
Yeah,
then
the cash
that
out
term.
refinance is again what we're not seeing a lot of in the last three
Right.
years because of the elevated interest rates. Because when you do a cash out refinance, you have to again pay off your previous mortgage, which most homeowners want to hold on to that lower 3% rate um, without refinancing to pull cash out. So this is again a second mortgage. The cash out refinance is a first mortgage where you combine everything and pay off
Okay,
existing
makes
mortgages.
sense.
Hmm.
Yeah, thanks for clarifying.
Yeah, no problem. And then one last slide here. This is something that's common we've used for years and years in the industry, is if you did want to purchase a property and maybe you had 10% to put down, you can take a second mortgage out, like we've mentioned, one of these HELOCs or HE loans would be another 10%. So hypothetically, you would then have 20% down on your home of being able to avoid mortgage insurance. So um, that's a good alternative as well for some homeowners, or some do the HELOC because they can afford that payment, but they wouldn't have the cash to maybe put into the home if they bought a home that's a fixer-upper or really needs a lot of work when they move in. Um, they can put money down and then also borrow a HELOC to kind of help them with that as well. So a lot of different options here. And if you have any questions at all, I'm always here to help. So we'll share my contact information here real quick. Bear with me. I'm gonna pull up another screen. And this is, I just wanted to touch on this too briefly. This is my blog. And so if you look at the URL at the top, you can visit my blog, and it's just another article that explains a lot of this um, equity loans and the time that we're in. That there's just so much accumulated equity in the last 5 to 10 years that it's just such a perfect loan for many. So just wanted to show that blog, and then you can also find me on my website here. And
Perfect.
that's my
Okay.
phone number. And yeah, if you ever need anything, I work closely with Jenica, so I'd love to help you if this is something you're interested in.
Thank you so much. And then if we could just
Yeah.
end with a couple other things. Well, one is that there's been talk about the 50-year mortgage. So I'd love to
Hmm.
know your thoughts on that and if what you think about that. Just to kind of, yeah, people are curious about it. So.
Yeah, the standard in the industry has always been a 30-year mortgage. Those are what we refer to as qualified mortgages. Um, they did come out with a 40-year mortgage not that long ago, and now a 50-year mortgage. The When we look at them side by side, a 30-year, a 40-year, and a 50-year, the 30-year is still the king. It's still going to have a lower rate. So that's the part that really wins out in most cases, is that your 30-year mortgage rate is going to be lower than the 40 and 50%, 50 years by quite a bit. So even if you spread out the amount of money you're borrowing, which is usually two to 300,000, let's say on average for a mortgage, you're not going to see a drop in mortgage payment, which people had assumed because you're spreading it out for 20 years longer than a 30-year mortgage. Because if the higher interest rate's a full percent higher, we've even seen in some scenarios where a 50-year mortgage will have a higher monthly payment, but then over the extra 20 years, you pay or finance another three, 400, almost a $500,000 in interest you'd be paying. So it can fit in some situations, and I think once there's more of a market for it, um, and what I mean by that is the secondary market and investors, if that starts to gain steam, then when the 50-year interest rates hypothetically come down closer to a 30-year rate, then I can see them really starting to pick up and gain steam. But right now, they're kind of in the new stage of, being talked about and looked at. And then as a loan officer, our job is to always present you options. And when we do sit down with our clients and go, well, here's why it maybe doesn't benefit you because, um, the other part, the big part there, Jenica, is that most homeowners keep a mortgage for about 7 years, 7, 8 years. So you're going to likely refinance. So taking out a 50-year mortgage, to me, again, kind of loses its benefit unless you can really have a big savings on a month-to-month basis. And right now we don't see that with the way the interest rates are structured.
Okay, and sorry, my dogs are going nuts. I was on mute
That's
for a
okay.
little bit, and I think somebody came to the door. I know, so the way that you're talking, is the 50-year mortgage, like, is that available as of today, or it's still like in talks?
Well, it's still being talked about more than being offered. And and although it can be offered through some non-QM lenders, like I said, it's still being worked out, like almost in its testing phase. And again, it become because of a lot of the interest rate environment we're in, the fact that the investors are trying to figure out those products, um, it can be offered, but it can be again not really a benefit at the moment until they work out some of the kinks.
Yeah, makes sense. I know I was going to say it's interesting about the investors because thinking about them and them wanting to have to buy those on the secondary market is like a whole nother, you know, part to it.
Yeah, exactly. And again, it has a good talking point, I would say. Like I said, if rates were even across the board and everything was the same, apples to apples, the rate was 6.25% and on a 30-year and 6.25% on a 50-year. Yes, then you could see a big, large savings monthly, maybe 400 or 500 bucks. But right now, it doesn't pencil out that way because the interest rates are about maybe 1% higher on a mortgage like that.
Yeah, makes sense.
Mhm.
Well, thank you so much for being here. And yeah, sorry about
Yeah,
my dogs. I think my husband's selling something on Facebook Marketplace, and I
that's
think the
okay.
dogs are barking all the time. But it's been great having you. Thank you for explaining all those options. I think it's good to know, what's available and what's out there. I think sometimes we, feel like we don't have options, but there definitely are options out there. And really for a lot of investors,
Mhm.
as far as how they build their wealth is through tapping into the equity in their other properties to continue to build that. So
Yeah.
we'll make sure to post Kyle's info on the comments on this Facebook Live as well. And yeah, we're just grateful that you're here. Thank you so much.
Yeah, no problem. It's always a pleasure talking to you, Jenica. So thanks for having me, and wish you guys all the best and happy holidays.
Thank you. Same to you. Bye.